Hello everyone. Today we are going to discuss about liquidity ratios. Before going to liquidity ratios, we have know the term ratio analysis. Ratio analysis is a technique that is used for analyze the financial statements. Here, ratio analysis is an important technique that is used for financial analysis. We know that every financial institution is prepare certain financial statements like balance sheet, profit and loss account, etc. Here, the company makes financial analysis for the purpose of analyzing the overall profitability, overall solvency and overall liquidity of the organization. Here, ratio analysis help to check the relationship between various elements in the financial statements. Ratio analysis is the most widely used technique for ascertaining financial statements. It is the first financial tool that is used for analyzing the financial statements. The concept of ratio analysis is developed by Alexander Wall in 1990. Next, check what you mean by ratio. Ratio means the relationship between two related figures expressed in mathematically. Here, we know that if a ratio analysis is doing by a company, there must be at least two characters or two figures. How we can calculate the ratio? The ratio is calculated by dividing one variable to another. One variable, one figure divided by the next variable. Next one, the meaning of ratio analysis. Ratio analysis means it is a technique that is used for analyze, comparison and interpretation of financial statements. Here, already we discussed that every firm is preparing their financial statements. The company making their financial statements for the purpose of evaluating their performance or evaluating their financial position. Here, it is helpful for knowing the liquidity, overall profitability and the financial position of a firm. Next one, accounting ratio. We are going to the main topic, accounting ratio. What do you mean by accounting ratio? Accounting ratios are ratios calculated from financial statements, or we can simply state that accounting ratios are ratios which is calculated by accounting information. When we are collecting the firm's balance sheet or firm's financial statements, here we are discussing about the ratios related to them. On behalf of accounting information, we are calculating the accounting ratio. The accounting ratio mainly expressed in four forms. First one, proportion and percentage, times and fraction. The accounting ratios are mainly expressed in four forms. First one is proportion, second one percentage and times and fraction. The accounting ratios are mainly classified into two types on the basis of structural classification and the next one on the basis of nature or function. On the basis of structural classification, it is again classified into three. First one, financial ratio or balance sheet ratios. Second one, profit and loss ratios. And third one is mixed ratios. Mixed ratio means the combination of financial ratio and profit and loss account ratio. On the basis of, it is least important in accounting ratios. We are discussing the main as basis of nature or function. First one, liquidity ratio. Second one, leverage ratios. Third one, activity ratio, and next one is profitability ratio, and last one is market test ratio. Here the accounting ratios are classified into two on the basis of structural classification. Second one on the basis of nature or function. On the basis of nature or function, it is again classified into five. First one is liquidity ratio, second one is leverage ratio, and third one is activity ratio, fourth one is profitability ratio, and last one is market test ratio. Here we are discussing the term liquidity ratio in deeply. What do you mean by liquidity? Liquidity simply means that the short-term solvency of a firm. Short-term solvency means the ability of a current assets to convert into cash. The ability of a firm to convert the current assets to cash. Liquidity ratios means it is measure the short-term solvency of a firm. Here, liquidity ratios are evaluated to measure the short-term solvency of a firm. The firm's ability to pay its current liabilities out of its current assets. The firm's ability to pay its current assets of its current liabilities. Here, the liquidity ratio are used to measure the short-term solvency of a firm. Liquidity ratios are mainly used to assess the short-term debt-paying ability of a firm. Here, these ratios are highly useful for the creditors and commercial banks that provide short-term credit. We all know that the financial institutions and commercial banks are providing financial assistance to the firms. So, while giving financial assistance to the firms, they consider the ratios, liquidity ratios as a mandatory. It shows that when the credit is to be repaid. The important liquidity ratios are, first one is current ratio, second one is quick ratio, and third one is super quick ratio. Here, the liquidity ratios are again classified into three. First one is current ratio, second one is quick ratio, and third one is super quick ratio. What do you mean by current ratio? The term current ratio indicates as the ratio of current assets to current liabilities. Here, the concept of current ratio is first developed in 1891. Current ratio means the ability of the firm to meet their current liabilities while using their current assets. It is also known as working capital ratio or bankers ratio. Here, we can calculate the current ratio while using the formula current ratio equal to current asset divided by current liability. Here we can see that the equation itself shows that two components. First one is current asset. Current asset means cash or those assets which can be converted into cash within a year. The second term is current liability. Current liability means those liabilities which are to be repaid with a year. Current assets means cash or those items which can be converted into cash within a year. Current liabilities means are those liabilities which can be repaid within a year. Here, in current assets, certain items are included. It includes the factors like cash in hand, cash at bank, marketable or short-term securities, short-term investments, bills receivable, sundry debtors, stock or inventories, work in progress, and prepaid expenses. These all are items comes under the category of current assets. Once again repeated, the current assets include cash in hand, cash at bank, marketable or short-term securities, short-term investments, bills receivable, sundry debtors, stock or inventories, work in progress, and last one is prepaid expenses. In current liabilities include the factors like sundry creditors, bills payable, outstanding expenses, short-term advances, provision for tax, dividend payable, and last one is bank overdraft. These all comes under the category of current liabilities. You are familiar with these two concepts. What do you mean by current assets and current liabilities? Let's move on to the current ratio. The standard current ratio is 2:1. That means the current asset is 2 and current liabilities is 1. Here we are calculating the current ratio. When the current ratio is above the standard, It is an indication that the firm is liquid and it has an ability to pay the short-term obligations as when they due. When the current ratio above the standard, it shows that the firm has highly liquid and the firm has the ability to pay their current liabilities or short-term obligations when they become due. Just opposite, if the standard current ratio is lesser than the actual current ratio, it shows that the liquidity position is not good and the firm will find difficulties to pay off debts. When the current ratio is lesser than the standard, it shows that the firm has a short-term liquidity position and the liquidity position is not good of the firm and the firm is faced to pay their debts in time. Next one, the second one is quick ratio. On the basis of classification of function, the accounting ratios are classified into liquidity ratio, activity ratio, profitability ratio, market test ratio and solvency ratio. Here, the liquidity ratio again classified into two: current ratio, quick ratio and super quick ratio. The second one is quick ratio, or it is also known as liquid ratio. Liquid ratio means the ratio of liquid assets to current liabilities. It is the ratio of liquid assets over current liabilities. Liquid assets also known as quick assets. Quick assets means it can be easily converted into cash or liquid form. It measures the instant debt paying ability of the business enterprise. Here we use quick ratios for measuring the firm's instant debt paying capacity. The quick ratio is also known as acid test ratio. It is important. It is also known as acid test ratio or near money ratio. Here we can calculate the quick ratio or liquid ratio on the basis of following formula. Liquid ratio equal to liquid assets divided by current liabilities. In this ratio, here there are two components. First one is liquid assets. Liquid assets means those assets which can be quickly convertible into cash without any loss of value. It is important. Liquid assets means those assets which can be quickly convertible into cash and without no loss of value. It includes all the current assets except inventories and prepaid expenses. How we can calculate the liquid assets? It is calculated by using the formula liquid assets equal to current assets minus stock and prepaid expenses or inventories or prepaid expenses. The next component is already we discussed in the current ratio, current liabilities. Current liabilities are those liabilities which are to be repaid when they are due, or it is repaid within an year. Here the standard quick ratio is 1:1. That means the liquid assets 1 and the current liabilities in a proportion of 1. Here we calculating the liquid ratio or quick ratio is higher than the standard. It indicates that the financial position of the firm is said to be good, and it means that the quick assets are sufficient to pay off the short-term obligations. If the quick ratio is greater than the standard, it means that the financial position of the firm is said to be good and quick assets are sufficient to meet to pay off the short-term obligations. Just opposite, here the quick ratio is lesser than the standard. It means that the financial position is said to be unsound. Here we are going to discuss the differences between current ratio and quick ratio. Current ratio indicates whether a firm is able to pay its current liabilities within a year. In quick ratio, it indicates whether a firm is able to pay their current liabilities within a month. In current ratio, here the current liabilities are paid within a year, and in quick ratio, the liabilities are paid within a month. Here, in current ratio, it is expressed the relationship between current assets and current liabilities. In quick ratio, it shows the relationship between quick assets or liquid assets and current liability. Here, the standard quick ratio is 2:1. That means the current assets and current liabilities are the proportion is 2:1. In quick ratio, the ideal standard quick ratio is 1:1. That means current liquid assets and current liabilities are the proportion 1:1. The last difference, in current ratio, inventories and prepaid expenses are considered as current assets. But in quick ratios, we ignore the term stock or inventory and prepaid expenses. Here, the value of inventory and prepaid expenses are not included in liquid assets. Why? These assets are not easily convertible into cash, or they can generate the exact value of the item. Next, we are going to discuss about the calculation of current ratio and quick ratio. Here you can see a question. Debtors rupees 2 lakh, bills receivable rupees 50,000, marketable securities rupees 1 lakh, stock rupees 1,80,000, prepaid expenses rupees 20,000. Next item is cash, that is rupees 10,000, bank overdraft rupees 1,75,000, sundry creditors rupees 2,30,000, and last item is bills payable rupees 75,000. While using this question, we can calculate the current ratio and quick ratio. First of all, here we are going to calculate the current ratio. What is the formula to find out the current ratio? Current ratio equal to current assets divided by current liability. It means that it shows the relationship between current assets and current liabilities. So the equation will be current assets divided by current liabilities. In this question, what are the items that are included in current assets? Just look at the question. It includes debtors, bills receivable, marketable securities, stock, prepaid expenses, and cash. In current ratio, all the assets include inventories and prepaid expenses are included in current assets. Is it? Okay. Then we can calculate the value of current asset. In the equation, we have to calculate the value of current assets and current liabilities. Then only we can calculate the value of current ratio. Here, the current assets include debtors. The value of debtors is rupees 2 lakh. And second item, bills receivable. Amount rupees 50,000. Next item, marketable securities. Rupees 1 lakh. Next item, stock. Amounted to rupees 1,80,000. And next one is prepaid expenses, which is amounted to rupees 20,000. And last item, which is come under current assets, cash, rupees 10,000. Just calculate the total of current assets. Here we can get current assets is equal to 5,60,000. Then we can calculate the current liabilities. Here in the question, the current liabilities include bank overdraft rupees 1,75,000, sundry creditors rupees 2,30,000 and bills payable rupees 75,000. You can calculate the total amount of current liabilities. It shows that the total of current liabilities is 4,80,000. In the equation, in the current ratio, the two factors or two components are already given: current assets and current liabilities. Current assets means rupees 5,60,000 and current liability is rupees 4,80,000. Therefore, we can calculate the current ratio. The equation for calculating the current ratio equal to current assets divided by current liability. Here current assets is 5,60,000 and current liability is 4,80,000. Therefore, we can get current ratio as 1.17:1. We can compare this actual current ratio with the standard. Here, the current ratio is below the standard. The standard current ratio is 2:1, isn't it? Here, we can get the current ratio as 1.17, which is lesser than the standard or lower than the standard. That means, while preparing the ratios, we must give an interpretation to every ratios. We must say the conclusion of what you meant by what you get from the current ratio. Here, it is stated that the current ratio is below the standard. So, it indicates that the firm's liquidity position is not good. So, it is indicate that the firm's liquidity position is not good and the firm will liable to pay their debts not at proper time, or the firm will find difficulties to pay off their debt. Next one is quick ratio. On the basis of the same question, we are going to calculate the quick ratio. Here, we are calculating the quick ratio by using the formula quick ratio equal to liquid assets divided by current liabilities. Here, we already state that current assets not include inventories and prepaid expenses. That is equal to liquid assets. Here, the value of inventories and prepaid expenses are ignored while calculating liquid assets. So, we can calculate the value of liquid assets from this question. Here, debtors is rupees 20,000 and marketable securities rupees 1 lakh, bills receivable rupees 50,000 and last one is cash rupees 10,000. You can total these elements. It shows that liquid assets equal to 3,60,000. The next component is to find out quick ratio is current liabilities. We already calculate the value of current asset from current ratio itself. Once again I have repeated, bank overdraft rupees 1,75,000, sundry creditors rupees 2,30,000, bills payable rupees 75,000. Here you can total the value of current liabilities. This shows that it already calculated the value of current liabilities rupees 4,80,000. Here we are calculating the quick ratio by using the formula quick assets or liquid assets divided by current liabilities. Here we get the value of liquid assets is rupees 3,60,000 and the value of current liabilities is rupees 4,80,000. Therefore, the value of quick ratio equal to 0.75:1. You can compare this ratio, the actual quick ratio with the standard. Here you can see that the quick ratio is below the standard. The standard quick ratio is 1.1. Here the actual quick ratio is the firm is 0.75. It is actually lower than the standard. So we must give a conclusion for quick ratio of the firm. Here it states that the quick ratio is below the standard. It shows the financial position is said to be unsound, and it means that the firm will not able to pay their debt within the specified time, or when the debt are acquired or due, they cannot pay at that time. Here we are discussed liquidity ratios in deeply, and the liquidity ratios include two categories. It is divided into two categories. First one is current ratio and second one is quick ratio. I hope you are already knowing with these ratios and familiar with these topics. Here I conclude my session and thank you.